Hey guys, this is Nathan and Bryan from bryanchavis.com and the Landlord Academy. We'd like to welcome you to our YouTube channel where we're here to teach you how to buy it, rent it, and profit. Thank you so much for joining us today. And Bryan, as always, thank you for being here, man.
Absolutely. Thanks for putting it on, Nate.
Absolutely. Well, one of the things that we wanted to talk to you guys about today is understanding your asset classes. You guys are going to be, trying to attract certain types of prospect tenants. It's important to understand the difference of the type of properties that you can actually invest in. So, Bryan, what I'd like you to do for, the next 10 minutes is really just break down the difference in asset classes, maybe talk about the pros of, the different classes, and also some of the things you should look out for, as people are looking to get these types of properties. And then, why is it important? First and foremost, why is it important to evaluate asset classes? Maybe you could tell us that.
Right. Yeah, that's a good question. Well, thanks, Nathan. Yeah, the importance of asset classes, really kind of stretches across the entire gamut of just basic understanding of real estate knowledge 101.
Right.
I think a lot of people really don't know how to, what asset class. Some may kind of get a broad understanding of what it means now that syndications and investing in apartments is much more prevalent than it was, a few years ago. Of course, definitely since I started, I think people have a better understanding. But as it really pertains to the investor, the group, the syndicator, it's extremely important that you understand your asset classes because, especially, with our current yield curve being inverted, which triggers the signs of a recession. And you've heard me talk about that in the previous videos we shot. All signs kind of point to a recession. And even if there's not a recession, at the end of the day, the talk of it still, has the effect on the overall market. So understanding what you're going to back yourself into, no investor wants to catch a dropping knife. No investor wants to buy an investment property and then, within 6 to 9 months, the markets change on them and the property is no longer operating like they thought it would be when they purchased it or they did their initial underwriting. That happened to me. I'm speaking from experience, and anything that I do, anything I talk about, I've rarely, and this from traveling with me all over, I rarely speak about anything that I haven't experienced myself. So I usually defer to someone else that I know has experienced it. I've experienced buying an apartment building and then having it the market change in 2008, and then having to hold on and really you felt like this little tiny ship out there in the ocean, and you had to you dump everything overboard. You had to get rid of the cooler, get rid of anything that wasn't nailed down. You got rid of to get light, and to try to ride this wave, this long recession wave. Unfortunately, the timeline was just far too long. And a lot of people didn't make it. And no matter how great of an operator they were, a lot of people, again, just didn't make it. So understanding that and going through that personally, and then understanding, okay, well, what does asset classes mean? I really have a better understanding, and I really have a better knowledge, and, more of a conscientious effort on my part as a syndicator now to look at deals that I know that would be resistant. Again, looking at Park Plaza Apartments in downtown St. Pete, people were like, oh, you paid market value for it. I think that's a 5.5 cap or something like that, 5.5. You paid market. Yeah, but I paid for the security. So, at the end of the day, I feel like the asset not only I thought was a value add, which we know it was. Now, it's no longer a hunch. I've executed on the rents. I'm getting 1,000 when the weighted average was 740. So you see, what I've done there. But at the end of the day, I still feel like if we do head into a recession, that downtown St. Pete is somewhat, recession proof. And if the rents do anything, they'll soften. Or not soften, they'll stabilize.
Right.
You know what I mean? Which means, okay, I'm getting 1,000 is right now in rents. I think I can probably even push these rents up to around 1,100.
Okay.
If we walk into a recession, that probably will peak right at around 975 to 1,000 is where I'll probably stabilize until after that recession. So at the end of the day, it's still much better than my pro forma at 850. You know what I mean? So I'm still getting $200 over my, I'm still getting 100 to 100 and to 75 to $100 more than my pro forma rent schedules. So, you know, at the end of the day, I'll take that. You know, in a recession, you still growing the rents, you know, 75 to $100, you know, who wouldn't take that? So, you know, but again, you know, people, if you don't really understand the business, a lot of people were like, are you crazy? You know, I don't know. Am I crazy or am I crazy like a fox? I chose the asset class of Class A, core market value. So, you know, when you ask me, you know, the importance of understanding your asset classes, I had to share that story because it's important that, you know, hey, at the end of the day, you're going to find lower cap rates in those asset classes, but you also find a lot more security, right. You know. So when people say, and I don't mind the risk factors either, but, you know, when people look at things and they say, well, you know, at the end of the day, Brian, you know what I mean? Will you ever touch, you know, moderate, you know, Class B property, Section 8 property, things of that nature? You know, the cap rates are much higher, the returns are much higher, and they are, but the risks are also much higher. So, you know what I mean? At the end of the day, the first people that are going to be touched from a recession are going to be your middle income demographic, you know, your prospect tenant, you know, those individuals, you know, their jobs at Walmart. And, you know what I mean? You know, at the end of the day, those jobs at Walmart and those mid-level, entry-level positions, those are the individuals that are going to be, you know, their wages are going to be cut back. So, you know, at the end of the day, your net operating income is going to suffer a little bit on some of those properties. So you need to back that into your underwriting when you're looking at these Class A, Class B. And the difference between, you know, the classes is typically, and I'll even give you a cap rate scale. Yeah. So on Class B or Class A, let's start at the top. Class A property, you're kind of looking at cap rates anywhere being between, you know, 3 to 6%, depending on, you know, where they're located. You know, so Class B, you're looking at anywhere between, you know, 5, your mid 5s to around, you know, your probably your 7, 8s. You know, Class B. Class C, you're looking, of course, a little higher. So you probably go at Class C. You can be anywhere between 8 to 14%, you know, as far as the cap rate is concerned. So, and you associate those higher and lower cap rates with higher and lower risks. So, you know, whatever your risk tolerance is, you know, that should be factored in.
So can you tell me more about that risk factor? When you think about lower risk in a Class A property, let's start with Class A. Why does it come with lower risk? Why does a Class A property give a lower cap, but yet
demographic,
lower risk?
Yep, good question. So it all comes down to the prospect tenant. It comes down to when you go through the CODA process, my strategic evaluation of a target area. It all comes down to your prospect tenant, and okay. You know, these individuals are less likely to be hit with a recession. They're young professionals. Their jobs are a little more stable than the associate at Walmart, the associate at Home Depot. You know what I mean? These jobs are your entry level professional, young professional, and your higher paid service industry, your bartenders and things of that nature. Though, you know, they may even, you know, be hit a tad bit as far as, you know, a slowdown in downtown St. Pete. But, right. You know, let's just be honest. We've seen many recessions before, and usually your areas where you have a lot of high, you know, traffic for tourism, you know, it really doesn't suffer that much. Again, like I said, I don't think you'll see a softening in rents. Right. What you're going to see is a stabilization. I'll take a stabilization 7 days a week, twice on Sunday.
Right, so exactly.
It kind of really always falls back on your prospect tenant. You've heard me say a million times, if you heard me say it once, buildings don't pay rent, people pay rent. Right. So, you know, they think multifamily is all about buying buildings. And there's something to be said for that. But, you know, I was trained in the multifamily industry that it's not about buildings. I quickly learned that it's more so about the demographics of your prospect tenant, right. Who they are. So when you understand who your prospect tenant is, and you understand how economic cycles could either, you know, how they affect them, you know, the pros and cons of any cycle and how it affects your prospect tenant, then you understand is really how to position your underwriting and your model when you're going out there looking for investment opportunities.
Right. Exactly. And so before we go into B class, I mean, people probably getting really excited. Okay, so I just need to focus on A class only. What is something that you need to look out for, or just think about before you just jump into A class properties? What are some of the challenges?
Price point.
Yeah.
Yep. Price point. I mean, if you're going to jump in and looking at A class properties, I mean, it's really not jumping into anything. First of all, you're looking for the returns. If, and again, are you a syndicator? Are you looking just to shelter and hide, put money into real estate? Mm-hmm. Not really necessarily looking for a strong return, but the safety, it depends on who your investors are, and what your model is. If you're a syndicator, if you're a group of investors, you're a group of friends, if you're a sole investor, I mean, you have different strategies, ideas of what you want to see for your returns on your investment. With that being said, I'm not saying you shy away from those higher returns, maybe in a more volatile markets. And I say they're volatile, meaning, because of a boom or possible recession. It's just, if you can handle that risk, if you can tolerate that, if you can stomach that, then, by all means, you feel you got the team to operate, then by all means jump in. At the end of the day, I feel like I got the skill sets to do so, but do you necessarily want to chase those higher yields? Some people may say yes. If you're a syndicator, you're making a ton of money on the promote side of things. Yeah. On your waterfall structure, you're going to look for more of an opportunity to do exactly that, to find those investments, those opportunities. You know what I mean? So you're going to be, looking at C class and B property to try to find those higher returns.
So real quick then, B. So A class properties, like you said, you just want to evaluate, what you want to get into. Like if you're a syndicator, that's going to come with a bit of a higher price point. So could you walk us through C class properties, that middle income demographic? Like,
yeah, C class.
Tell us more about that.
So more the lower of the scale, the riskier projects. And you can see tons of videos of me going in on YouTube, with that asset class. And that's typically where, you're dealing with your Section 8, your low income type of properties in the rougher neighborhoods. Excuse me. Again, tons of return opportunities there, but tons of risk, tons of turnover. It's a different prospect tenant demographic. So that demographic, there's not a lot of stability there. So you're depending on, the government voucher, which is fine. But again, with the current administration in place, depending on a government voucher and thinking that, that may be there, it may not. The mm-hmm. Republicans are not that, and I'm neither Republican nor Democrat. I can care less. I'm a capitalist. I'm all about opportunity. At the end of the day, no matter who's in the White House or who's in Washington. With that being said, when you have a party that's in there, that's more like, hey, no, they're more so, they don't focus on the affordable housing crisis as much as the Democrats do. So, with that being said, if an individual is in the White House and, they're looking at building a wall, you got to kind of think, when their monies were shut down and some of their revenue opportunities are not accessible to them, they're going to be looking at other sources to build the wall. And, you got to kind of think that some of those other sources may come from the military, and they may come from, obviously, from affordable housing, the HUD department. So, you may get a phone call, Ben, what's his name? Ben Carson may be getting a phone call shortly, if he hadn't already, to start bringing in his budget.
Right.
And, and they start tapping into that. It's a logical move. For me, it would be a logical move because no one in that affordable housing sector probably voted for me anyway. So why not tap those resources and that income to help build my wall? So, some may argue yay, some may argue no. I'm just simply saying I have to look at it, right? As a syndicator, as an investor, I have to look at that as it being an opportunity or a lever that, the president may pull. I'm saying whether he pulls it or not, it's not my, I'm not getting that. I don't have a dog in that fight.
Right.
So, whether he pulls that lever or not, what I will say is I'll have a dog in that fight if you ask me to buy a C-class investment project and now I got a property and let's just say it's 40% Section 8. And then, the Section 8 funding, kind of bottlenecked, that will affect you as an operator, because now you have to go to conventional. Now you're going to have to tap those residents and say, hey, look, you guys need to pay rent. Your Section 8 hasn't paid. And now you're talking about eviction costs. Now you're talking about, having to switch over to conventional. And again, if the market is slow and you're in a moderate recession, the income may not be coming in like it once was projected. If there's debt on that property,
right.
You got a mortgage payment every month. I mean, that's going to pose problems. So, these are things that individuals will need to look at. Most won't, because most, probably have no interest, or, it's not like we're getting 50,000 viewers on our YouTube yet.
I think it's you don't know what you don't know, and if you have this desire to buy this multifamily property, a lot of times what I've learned from working with you is some of the agents aren't necessarily knowledgeable either, so they're just looking at
the agents and transaction brokers and agents, and at the end of the day, I have no knock against anyone.
Right.
Again, whether you're agent. No, there's just a lot of people who don't really understand this. There's a lot of people who invest that don't understand what it is that I'm saying. Don't really look at this, and they do not dot their I's or cross their T's or do the carpenter rule, measure twice, cut once. There's a lot of people that overlook this. I mean, you've seen it in the last recession. You'll see it again. It's going to pose an opportunity for individuals like me that when these properties get into trouble in a few years, then investors such as myself will see these opportunities to wholesale and or pick up deals. So, it's a part of the process. Some people pay attention. Some people focus on fundamentals. Some people don't. That's just the way it is in any business. You know what I mean? At the end of the day. So, man. I'm hoping people look at these videos and they listen and they kind of understand, because what I'm saying is not. It's not stuff that I'm making up. It's not stuff that, it's like, oh, he read this in the book. No, I've experienced this. I've lived it. This is the only business I really know. Yeah. I've done every aspect of this business except for the maintenance side, but I've done tons of projects, thousands of units in rehab. I mean, there's nothing that anyone can tell me about this industry. I don't care who you are.
Right.
There's a reason why my book is in the U.S. Library of Congress when I wrote it, because I wrote it from a perspective of actually doing it as a practitioner. And having an experience in every job. And I'm telling you, every asset class is going to operate different, because every asset class is dependent upon a prospect tenant that differs from zip code to zip code to zip code to zip code.
Right.
So, it's, what rules and regulations and qualifying criteria works for one property, it may not work for another property. What works at, what works at Park Plaza if I went and bought something by USF, in Tampa, in that area, that zip code, what works for Park Plaza, rules, regulations, qualifying criteria, may not work for that property in North Tampa.
Right.
As long as I'm not violating fair housing laws, but I am having to change the rules and regulations and the qualifying criteria, to fit the demographic to, my prospect tenants' demographics.
Yeah.
Again, that's just fun. Those are fundamentals. That's business.
Yeah, exactly. So as you guys are watching these videos, you might be thinking, okay, I'm focusing on growing my portfolio. I just want to grow units, and you're not thinking about the different asset classes that you're acquiring. You're not changing up your strategy for each asset class. You're going to find yourself in a lot of trouble. And that's why it's so important to, go through the due diligence process, really understand what you're looking at. And make a decision if you want to work with one particular asset class, or if you want to, mix it up and do, the whole gamut. You just have to
right.
For all of it.
Yeah. And, and people ask, will asset classes change? Can they change? I mean, that depends on there's the two questions. Is the market changing, and is the demographic in that area, has the area changed? You've seen gentrification in areas.
Yeah.
Asset classes are only going to change according to the neighborhoods and the markets that it's surrounded. So you have a neighborhood evaluation, you have a market evaluation, which is like a 6-mile radius. I think Park Plaza was an asset class that changed to a core, because downtown St. Pete was one of the worst. When we bought back in 2008, when I had the Palms in 2008, nobody was in downtown St. Pete, but the winos and the homeless, it was rough. I mean, you look at, let's take New York City. Everybody loves New York, right? Everybody knows New York. But, you know, when Mayor Giuliani got there, it was a nightmare. Walk up and down Times Square and all that. You know, people see what Times Square is now, but back then it was the junkies, it was the prostitutes, it was all the little strip joints. It wasn't what it is now. So can gentrification, you know, can things happen and change where asset classes change? Absolutely. Asset classes can change. But that process is slow moving. I mean, because you're talking about, you know, the whole entire neighborhood having to change. So government's got to get involved. People have to get involved. Money has to get involved. Big business has to get involved. You'll see that when Amazon comes and plops into an area, everything changes. You see that when Walmart, Nathan, plops in an area. You'll see that asset classes can somewhat change then because a super Walmart has been popped in. So it changes the whole entire economics of the neighborhood. You'll have a lot of more strip centers, a lot more gas stations and things of that nature pop in. Then you'll have multifamily development pop in. And so, yeah, you see a slow ramp up with the neighborhood. And then you'll see a slow change of the prospect tenant's demographic. And when you see a slow change of the prospect tenant's demographic, then you see a change in the asset class.
That makes sense, man. Well, I mean, and once again, this is why it's so important to focus on your asset class. This is just one of many things that you teach in your class. You know, I've been traveling with you for years. We've watched other people, you know, build their portfolios. We've taught other people how to build their portfolios. And there is a huge level of, you know, there's all these different processes that you want to take before jumping into your multifamily properties. So what we'd like to do is, you know, if you like this video, make sure you like, make sure you subscribe to our channel, and also visit bryanchavis.com, where you can actually sign up for our group coaching. You can also sign up for one-on-one coaching, and this is one of many segments that's going to be in our masterclass. So, you know, visit our website and make sure you sign up to get, you know, free content, but also sign up for the group coaching and the masterclass, because, you know, when you're looking to buy your properties, you're going to want to make sure that you're protected, make sure that you know what you're doing. And, you know, it's not really someone better than Bryan to work with. So.
Absolutely. I would love to have, you know, I'm excited about the coaching program moving forward in the next quarter. Having the Bryan Chavis coaching program, what I call the elite coaching. I didn't have this opportunity, Nate. I didn't have anyone that can narrow it down for me and teach me step by step, you know, invite me over to the property and show me and do Zoom calls like this and walk me through the process. So, you know, I'm really excited about the elite coaching. I'm excited about our YouTube channel. I'm excited about everything we're doing. But yeah, those are the things that I'm really excited about. The YouTube channel, and I'll post it on Facebook as well as I'll make sure I get it out in our everywhere about the group coaching and the elite coaching, because I feel like it's a program that's going to change.
Absolutely.
We're going to be talking about wholesaling. We're going to be talking about how to get involved, because a lot of people are thinking, oh man, I can't get involved with this apartment business. You know, that's just too much money. Number one, as a syndicator, you don't need money. You don't even need credit as a syndicator. Number two, I mean, you know, if you need to put money in your pocket, then you wholesale a few deals. Mm-hmm. And there's no one. My brother sent me a couple of deals yesterday because he was out, I don't know what he was out doing, riding around Lakeland, Florida. And, you know, he seen me in Brooksville the other day. And, you know, my brother was like, wait a minute, Bryan, I've got 5 or 6, you know, where I hang out, there's 5 or 6 vacant buildings, you know, down the street from one of my homeboys' houses, blah, blah, blah. You know, let me go take some pictures and bring the address. You know, there it is. You know, and absolutely, these deals look really, they I'm like, wait a minute. Yeah, let's, you know, so we're investigating that. We're taking a look at it. But at the end of the day, man, it's like, you know, there it is. There's property everywhere. And a lot of people, they'll wholesale single family houses all day, Nate. Why? Because it's easy. It makes sense. And I don't blame them. It makes sense. But everybody and their mom is doing it. Nobody's touching that boarded up duplex and small apartment building. Everyone's scared of that. Number one, they don't know how to evaluate it. Number two, all the demographics, all this stuff we're talking about, it's like, oh man, I ain't got time for that. I'd rather just flip a house. Well, knock yourself out. While you make $7,000, $8,000, $10,000, $15,000, I'll make 7 figures flipping a small apartment building, doing the same amount of work, if not less. You know what I mean? So, you know, it's for me, that's just common sense. But you know, so yeah, you can get involved with this at any level. It doesn't really matter your level. You know, there's opportunities in what we're doing to get involved with the coaching and really learn how to build yourself a syndication business, a true business, because there's a lot of folks talk about building wealth in real estate. And I'm gonna be honest with you, Nate. Let's just call a spade and put a lot of stuff to rest.
Yeah.
Building wealth in real estate doesn't come from, and I love everything about wholesaling. I love everything about flipping. I love everything about, everybody getting involved with real estate at a certain level. But if you don't own the building, if you don't have buildings on blocks and in neighborhoods, you don't own the building, you can't talk to me about getting rich and building wealth. What you're talking about is very cyclical. You might have some time periods where flipping is great and wholesaling is great, but there's going to be time periods. Let's just be honest with everybody doing it. There's going to be time periods where things are going to be really slow and famine. You need passive income that's coming in while you're asleep. That's why I like property management. That's why I like, apartments. It's because we're talking about passive income. That might work on social media. That might work with a certain demographic, with a lot of folks that see things on TV and they see somebody getting out of a fancy car or wearing a fancy suit and talking about how to get rich in real estate. Listen, if they don't own a building, they can't talk to me about building wealth.
Right.
If you're not talking about if you can't walk me to a spot and say, yeah, I got ownership in that building, don't talk to me about flipping something or wholesaling something or anything alike if you don't own it and it's not passive and you can't sleep and it's making money for you. That's owning assets. You don't own an asset. And even as a salesperson, if you're hey man, I'm one of the top producers in Keller Williams or Remax, you're selling people stuff. You don't own nothing. You don't own anything. Until you own something, you can't talk to me about wealth. You're talking about getting rich. There's a big difference between being rich and being wealthy. You know what I mean? At the end of the day, so you got to just really understand it and commit to what you're talking about doing and what you want to do. But if you're gonna be led astray with everybody talking about getting rich in real estate and building real estate empires, but they ain't talking about owning the building.
Right.
Come on, man. You can't get rich. I mean, you might can get rich for a period of time, but you can't build wealth. You understand what I'm saying, Nathan? You cannot build wealth without owning the building, bro. Where you live, those people, that apartment building, that's wealth building. The people that own the building that you walk into at night, that's wealth building.
Yeah.
So, again, I digress. I don't want to go too much on a rant, but it just, it frustrates me a tad bit to see a lot that I see out there on social media and people talking about how to get rich in real estate. It's like, don't teach me about getting rich, brother. Teach me about building wealth to where my kids don't have to worry about the things that I worried about coming up, to where my family doesn't have to worry about the things that, that they worried about coming up. That's wealth. To worrying about, a recession is coming. And if I got a homeboy that's wholesaling, my partner, Joey, we're always talking about that, hey, look, things will slow down on that wholesale business if the recession comes. That's not anything I want to, necessarily adopt in my philosophy full time. Right. I want to talk to the person that can show me how to build wealth in my sleep. How I can drive the streets and show my kids. You see that building right there? You see the pictures on social media with my child watering the plants out there. She's watering that because she knows she's got ownership. That's her building. Mm-hmm. She's watered that because one day she'll own and operate that. That's the start of the seed that started Chavis Capital. She knows that her daddy owns those buildings. That's wealth. That's what I'm talking about, teaching my kids. That's what I'm trying to talk to the people in social media while we're doing these videos, because I really want to get straight about what's the difference between rich and being wealthy. Because, if we're just going to talk about just getting rich, that's cyclical. Right. And that's subject to change at any time. And so that's why I think the coaching and the mentorships and the things that understanding who is and what people are saying and being able to see past the fancy car, see past the fancy suit, see past the fancy office, see past all that and just get to the question of what do you own and how do you own it?
Agreed.
Like I said, I digress. I'll step off.
Not really digression, man. We talk about this all the time. So, I'm glad that, people are able to see, the passion and what we are trying to do. We are trying to help you build wealth, long-term wealth, owning units, and really not finding yourself in trouble, because if you jump right into this, there's a whole host of things that can go wrong without the right coaching and training. So we've learned everything through our hard knocks. We're here to teach that to you guys. So once again, visit bryanchavis.com, sign up for your coaching, sign up for the masterclass, and keep watching our YouTube channel. Make sure you like and subscribe, and we will be speaking with you guys next week. Thanks so much for joining us.
Stay blessed, guys. Thank you for joining us.